Hi everyone, my name is Jason Choy, Senior Portfolio Manager at InvestNow, and welcome to InvestNow's monthly wrap-up. Financial markets can often be unnecessarily noisy and complicated. With so many headlines clamoring for our attention, it's often hard to keep up with what's actually relevant to each of our investing journeys. So, InvestNow's here to help. Each month, our monthly market wrap-up will distill the key events in the wide world of investments into digestible bites curated for the Kiwi investor. Here at InvestNow, one of our 10 investment guiding principles is to stay informed but avoid the noise. That means while it's important to keep abreast of what's happening in markets, savvy investors should also resist the urge to change their long-term investment strategies in response to market volatility and noise. Today, I'm joined by Chris Di Leva, Director and Portfolio Manager at Harbour Asset Management, who's kindly joined us today to break down a busy month in markets over September. Chris, thanks for joining us today.
Thanks, Jason.
So let's kick into the September market wrap-up then, shall we? As it's certainly been an eventful month in markets lately. So Chris, September's come and gone, and this market dashboard, which handily summarizes the recent performances of a few key indices from both global as well as local markets. Is there anything that really sticks out to you here?
Yeah, firstly, just how uniformly kind of weak markets were in September, but particularly as we go out and look at those year-to-date numbers, we've seen the New Zealand market dip below zero now for the year-to-date. To me, that reflects kind of one key thing, and that is just how narrow equity markets have been so far in 2023. If you take out the Magnificent Seven, which some watchers might be quite familiar with, it's got the likes of Meta, the other FANGs, Nvidia, and Tesla in it. The global share market's returns have actually been quite modest, and the average stock, as opposed to kind of the market cap weighted index, has actually been pretty close to flat so far in 2023. So when you look at the New Zealand market, don't think of it being any New Zealand specific problems. It more just reflects the mix of assets that we have here in New Zealand. The other thing that stands out to me is that equities and bonds have continued to be quite correlated. And that's something we've kind of seen over the past 3 years. So in both 2021 and 2022, we saw New Zealand bonds and New Zealand equities deliver negative returns in the same year. That's quite an uncommon occurrence, but we're actually seeing it again this year. And the reason I find that interesting is that's such a big historical anomaly. We've done a lot of analysis at Harbour around how often over the past 70 years have bonds and equities in New Zealand delivered negative returns in the same year. It's only happened 4 times in the past 70 years. So this positive correlation between equities and bonds isn't particularly handy for portfolios. But we can see it's persisted again in 2023, and happy to touch later on why we think that correlation actually might not persist going forward.
Yeah, that's a great point, Chris. You certainly highlighted September. We saw a sea of red, not just in global equity markets, but also bond markets, which is super rare. And I guess September has historically been cited as one of the worst performing months of the year, specifically for equity markets, and particularly in the US, what some market watchers call the September effect. Just wanted to get your view on, do you place any weight on September's historic reputation as a drag on markets? And if not, what would you say were some of the main reasons for September 2023's poor performance?
Yeah, to be completely honest with you, Jason, we don't put a huge amount of weight in the September effect. When we look down at the data there, it pretty much comes down to 2 periods where returns were severely negative in September. One of them was obviously the fall of Lehman Brothers in 2008, which led to large negative double-digit returns, which impacts the data that you're seeing in front of you on the screen. I think the key thing that really drove things in September was interest rates. We have continued to see, in the US in particular, really robust data. And some of you watching might think, well, isn't good data a good thing? Sometimes good news is good news. Sometimes good economic news can actually be bad news for markets. And you might be asking yourself, well, why might that be? The key reason is that markets haven't quite put inflation in the rearview mirror yet. We've seen really positive falls in inflation from very elevated levels, but in most developed economies, you've still got inflation with a 4 or a 3 handle on it. So markets still worried about that. So when we get really hot employment data and we get hot economic data, markets actually get a little bit worried. And we saw that in the September quarter. We saw that particularly in the month of September, where the US 10-year Treasury yield increased by 50 basis points. That is a key metric used to value equities. So, Jason, when I look at September, I think it was really a strong economic data story and a bond yield story, which really impacted equity markets.
Yeah. So honing in on your comments about bond yields, and you can kind of see in this chart here just how bond yields, especially in the US 10-year Treasury, has skyrocketed, particularly in September. I mean, I think it hit a 16-year high, which, for context, back in 2007, that's a pre-smartphone era, this is a pre-Obama era. The All Blacks just had one World Cup to their name, so a lot has happened since then. So could you kind of walk us through, for those who may be a little bit less familiar, why, even if you're a pure equity or a share investor, should you be interested in the rise in fixed income yields and how that impacts equity markets?
Yeah, so we monitor something called the equity risk premium because fundamentally as an investor, you've kind of got two really big asset classes, right? You've got equities and you've got bonds. Now, through time, you would expect by holding equities, you will get a higher return, right? And what we monitor on a forward-looking basis is the earnings yield of the equity market minus the bond yield. And typically, equities should have a much higher earnings yield than the bond yield, right? Because you want to be rewarded for the additional risk that you're taking on. Right now, the spread between the earnings yield and bond yield is really, really narrow. So the relative attractiveness of equities as a result, in our view, is less so. And I think on this next chart we've got, Jason, we kind of plot this quite interesting relationship. And I really just want you to focus on two key things when you look at this chart. One is the red dot, and that's where we were a year ago. So what that red dot is telling you is a year ago, we had lower real 10-year bond yields. So a real 10-year yield is your nominal yield, and then you take off the impact of inflation. Now, typically, the lower the real yield, now I'm going to make sure I get this the right way around. Yeah, so typically the lower the real yield you get, the higher valuation you would expect in equity markets, right? Because you've got a lower discount rate to deduct off your future cash flows.
Yeah, you've got that
but
right.
What's interesting is today we actually have a higher real yield, and this is using the US 10-year real yield. We use the US versus the global market because the US is the reserve currency of the world, right? But that real yield has increased, and actually valuations have increased at the same time, which doesn't actually make a lot of sense. And if you look at the relationship through time, and this is plotting monthly data points over the past decade, the relationship we've observed over the last decade is quite different to what we've seen over the past 12 months. So we actually think within equity markets, over the past year or so, they've become a little bit disconnected from bond yields. And look, when we look at it, we think the relative value as a result over the next 12 months kind of leads us to like bonds over equities as a result, because we still think equities could have some further adjustment to go in response really to these higher real yields.
Yeah, absolutely. And I know Harbour is a very well storied active manager. So I'm sure you've reflected this investment view in your own funds. Could you kind of walk me through, for example, how your active growth fund is currently positioned?
Yeah, so look, we're underweight equities relative to bonds. Look, we think bonds, particularly New Zealand bonds, could deliver higher returns than equities over the next 12 months, particularly when we adjust for the risk. And you kind of look and you say, well, why would that be? We've got a really good starting point with running yields. So typically in fixed income, simplistically, you can get your returns from two places, right? You get your coupon every month, and we've got some global bonds in the portfolio which yield between 7 and 7.5%. We've got some domestic bonds which yield about 6 to 6.5%. So as a bond investor, we're obviously clipping the coupon every month and getting return there. But what could add the extra juice to returns over the next 12 months, in our opinion, is market bond yields falling. Particularly in New Zealand, we see pretty good scope, actually, in New Zealand for there to be cuts to the OCR over the next 2 years, particularly as households in New Zealand adjust to these higher mortgage rates, which will put a dampener on consumption. So as a result, that's actually not priced in by the market at the moment. So we think by going overweight New Zealand bonds relative to equities, we think we're going to be able to deliver some excess returns for clients, since valuations do look high on both on an absolute basis and relative to bonds within the equity market. That just makes us a little more circumspect with having too high of an equity position at this point.
Yeah, you really make an interesting point there, because I know, over the September month, we did see some news released that the New Zealand economy saw economic growth in the most recent second quarter, and they actually also revised the economic growth in the Q1, which take us officially out of recession. So for many Kiwis, you might think, well, if we're out of recession, that's quite good news. So, would that not normally mean that, share markets are on the way up? Why would you be underweight bonds? Could you maybe walk us through that notion of how good news isn't always good news?
Yeah, so a couple of interesting things with the New Zealand share market. And the first thing I'd point out is the New Zealand share market and the New Zealand economy are really quite different. If you look through the companies listed in New Zealand, we don't have a large amount of companies on the stock exchange that are really tied to New Zealand Inc. or the New Zealand economy. Just look through the top 10 holdings of the New Zealand share market and you'll I think you'll agree with me. So let's kind of park the New Zealand share market, because I don't think the underperformance of the New Zealand share market is down to the economy. I think it's down to our mix of sectors that we have, which are quite different to what we see listed globally. So the stocks that have really performed over the past few years, we had energy in 2022. In 2023, it's been all about tech. They're not large parts of the New Zealand market. So it's really been what's driven the New Zealand share market has more been what we don't have rather than kind of what we have listed here. If I talk more specifically about the New Zealand economy, we still think consumption is going to be really challenged. over the next year or so, and that really gives us our conviction to be overweight the New Zealand bond market. So, because if you had a really strong view on the New Zealand economy, you would probably say actually the Reserve Bank might not need to cut interest rates over the next few years because the economy might still be running hot and inflation might ultimately be running hot alongside it. But ultimately, we think households are starting to feel the pinch. We know that monetary policy takes time to work through an economy. We know by observing what average mortgage rates are at the moment, we know they have room to increase compared to the mortgage rates that are being seen when rolling mortgages today. So, yeah, we do think the New Zealand consumer probably has a little bit of a tough time ahead. But look, as I say, that's not going to be too much of an impact on our share market. It could actually be a positive thing if we see bond yields falling in New Zealand. That could ultimately be quite a positive thing for some sectors in the New Zealand share market. For example, real estate investment trusts, the electricity generators. They might actually respond quite well to a weakening New Zealand economy because it'll probably mean that we'll get interest rates down.
Yeah, you've absolutely hit the nail on the head, Chris. So, just because the headline says we're out of a recession, it doesn't necessarily mean, for the average Kiwi, that it could very much feel like a recession. I mean, given mortgage rates for a lot of people, they're locked in at COVID lows. They're kind of refixing at almost stress test levels back then. So for a lot of people, they will be feeling the pinch, and that is reflected in, the wider society. So, these insights from you, Chris, is really great. And I think it really highlights one of InvestNow's other investment principles. There are a lot of different investment styles that are complementary. So having an active approach, for example, like what Harbour does, certainly makes a lot of sense when you've got the breadth of experience in markets like Chris and his team does. But equally, if you're a more cost-conscious, investor, then equally, a passive or index approaching type of investment approach also makes a lot of sense. So, Chris, I think any final comments then, or maybe a forecast for the final quarter or the 12 months ahead?
Oh, look, 12 months ahead, we're probably going to be talking less about inflation in 12 months' time. That's certainly our view. It's been something that has been just the hot topic in markets kind of since late 2021. And something for watchers to consider is, as the conversation becomes less about inflation, we ought to expect the negative correlation between bonds and equities to resume. One of the reasons that bonds and equities haven't been a perfect hedge is because the equity market has kind of reacted to the bond market, which has then reacted to inflation. So it's been the kind of same thing driving both equities and bonds. What I'd say going forward is, particularly if the conversation moves to worries about growth, that is actually when we'd expect to see equities and bonds deliver that negative correlation that you expect. And I think we've seen bouts of that. For example, when we saw the concerns flare up in the US around the regional banking crisis in March, we saw equities sharply down, but we also saw bond yields fall, which meant positive returns out of bonds. So I think that's something that in 12 months' time, we might not be talking about this positive correlation between equities and bonds. I think the conversation would have probably moved on by then.
Yep. Yeah, great take. And, maybe we can catch up in 12 months' time and see how that panned out. So I think that's about a wrap then on the InvestNow Market Wrap for today. Chris, thanks so much for your time again and for your excellent insights. I'm sure you're putting all those hard-earned views to work within your funds. If any of you want to check out more from Harbour and all the great work that Chris and his team does, you can check out the Harbour landing page on investnow.co.nz. Equally, if you want to check out the written market wrap-up piece accompanying this video, check out the link on your screen. So thanks, Chris, and thanks everyone for your time. We'll catch you next month. Cheers.